Hi everyone, this week tutorial about moral hazard. In this tutorial I will discuss different statements, different phenomena, and explain how related they are to the moral hazard concept seen in the lecture. Before I get into them, a quick reminder on what moral hazard is about. Moral hazard is the consequence of a situation where one or several agents taking part in a contract, an agreement, can take hidden actions. Moral hazard typically happens when, first of all, interests diverge in the agreement and actions are not observable. Typical case, a worker who signs a work contract wants to get paid as much as possible while providing as little effort as possible. Effort is typically costly to provide, so this is something that a worker would like to avoid. The principal, or the employer, is the one writing the contract. He wants to pay the employee as little as possible because it represents a cost to the company, while wanting the worker to provide as much effort as possible in general. Their interests diverge, and on top of that, the effort that the worker can put into his work is not always observable, so that after signing the contract, workers might have an incentive to show no effort, to provide no effort. In insurance, full insurance will increase risky behaviors. A driver might take more risk on the road. A customer might engage in harmful eating habits, such as eating junk food and things like that, because he knows that his health expenses will be covered, and so on and so forth. In general, not exposing the agent to risk is going to lead to moral hazard. So a typical solution to moral hazard problems is to expose the agent to some sort of risk. A fixed rate acts like full insurance. So a way to make sure that the employee is going to provide effort is to propose some sort of a variable pay. This can be done in the form of commission, royalties, bonuses, and so on. Same in the case of insurance. Providing partial insurance is a way to make sure that the customer will not engage in the bad behavior, knowing that if something bad happens, he will not be fully covered by the insurance company. Let's get into some of these situations and see how they relate to moral hazard. In agriculture, farmers may work their own land, or landowners contract with farmers to work their land on a time rate basis. So they hire by the hour or by the day. Or sharecrop basis. Farmers split their crop with landowners. A recent study found that sharecrop workers and farm owners consume roughly 20% more calories per day than time rate workers. First of all, consuming more calories while holding everything else constant means that somebody is exerting more effort. Somebody is having more activity. So according to this study, sharecrop workers and farm owners consume more calories, so provide more effort or more active than time rate workers. So here we are comparing two different types of contracts, and we are looking at the amount of effort provided by the agent in each case. So the farmer's willingness to work hard depends on the type of contract that is being used. Farmers who own their land keep all of the marginal profit from additional work. So if they work 1 extra hour, all the money generated will go directly to their pockets in the form of profits. Those who do sharecropping will keep only a certain part of that profit. but they will probably put in less effort than if they owned the whole land. Farmers who work on a time rate basis will keep no revenue at all. Whether this extra amount of work is very productive or not will not affect their wage. They are paid a fixed amount of money per hour. So whatever they provide during that hour is going to be irrelevant when it comes to getting paid. Unless maybe they are closely supervised. So the lower calorie consumption of the farmers on time rates thus confirms the prediction that they work less than their counterparts, the ones who either own their land or the ones who sharecrop. According to this study, sharecrop workers and landowners both seem to exert the same amount of calories, which is 20% more than time rate workers. However, from an economic point of view, since a landowner owns 100% of the extra hour worked, 100% of the revenue generated by an extra hour of work, as opposed to sharecrop, which only get a certain percentage of that extra revenue, we should expect landowners to work even harder than sharecrop workers. According to this study, this was not the case. But the main distinction here between the three different types of contracts is that two of them, landowners and sharecrops, consist in exposing the agent to risk. His revenue is directly correlated to the amount of effort he's going to provide. In the third type of contract, time rate workers, the amount of effort they provide is not going to affect their wage as long as they show up and work a certain amount of hours a day. It is the same as working in a clothing store and getting paid by commission or on a fixed wage basis. You can very easily see the ones who are paid on a commission basis, because as soon as you step in the store, they will come to you and say, "Hi, how are you? How can I help you?" The ones who are not so, the ones who won't come to you are probably the ones who are paid on a fixed wage basis. So they don't need to make a sale to get paid. They might still provide some guidance and some advice because it is also part of their duties, but they won't be as motivated as the ones who are fully getting paid from what they are going to sell. Let's go over the banking system. When taking out a loan, banks generally will ask for a collateral. Why? Moreover, low-income households often have difficulty obtaining bank loans due to a lack of credit history and a collateral. Those households participate in the subprime market, where they can get a loan only if they pay more than prime customers. What is the idea of a collateral? A collateral is a way for the bank to insure itself in case of a default. If you contract a loan and you cannot repay it, but there is a collateral in the contract, then the bank can come and seize that collateral as a way to repay itself. If you are getting a loan for a house, typically the house can be used as a collateral. So in case you cannot repay your loan, the bank will seize your house. And so the bank will be able to seize your asset and repay itself. So a collateral is generally required to alleviate the moral hazard problem of not repaying a loan. Remember that default can be either intentional or unintentional. You might not be able to repay a loan because you simply don't have the funds, but there is also a thing called strategic default. Pretending you cannot repay a loan, whereas you actually can. In either case, having a collateral in the contract will make sure that if you cannot repay your loan, you cannot walk away from the bank unharmed. You will have to give something to the bank, the collateral. This will limit incentives to strategically default on your loan, or it will give you incentives to be pretty thorough when repaying your loan. Default is an observable event, so the contract here, the collateral, is a clause that is going to depend on something observable, the default. It is related to the propensity of households to stick to the agreed repayment schedule. In the event of a default, the collateral is seized and the household is punished. So the household is exposed to risk. The household cannot simply say, I don't have any money to repay you, and walk away. This motivates the household to keep repaying their loans. Households who cannot post a collateral have no such means of commitment and are therefore more likely not to repay the loans. It might also be harder to get a loan if you have no way to provide a collateral. Banks might be reluctant to offer you a loan if there is no way for them to make sure that they will get something in case of a default. The industry anticipates this moral hazard behavior and accordingly increases the price of a loan to compensate for the additional default risk. In the previous tutorial about adverse selection, I also talked about collateral as a way to screen across borrowers. The adverse selection story is some borrowers are just bad borrowers by nature. They tend to not meet their deadlines, they accumulate overdraft, and so on and so forth. Whereas others are pretty disciplined and always repay the loans in time. A collateral can be a way to make sure that a bad borrower might not accept the loan, knowing that himself is pretty likely to default on his loan. The other side, the moral hazard side, is that the collateral is a way to make sure that any borrower, whether he's a good borrower or bad borrower, will behave after the contract loan is signed. If he doesn't behave well, as in if he doesn't repay his loans in time, then his collateral will be seized, exposing him to a loss. So if a household doesn't have the way to provide a collateral in case of a default, then banks will only accept to lend money to a borrower if interest rates are higher, hence the subprime market. Some consumers who cannot commit to provide a collateral in case of a default will then have to pay more than prime customers. And they might be subject to variable mortgage rates. That was one of the types of contracts that happened at the beginning of the 2000s in the US in particular, and that led eventually to the subprime crisis. The interest rates on those loans being variable, they eventually increased due to other economic factors. And those borrowers who were told that there was no way they would have to pay a high interest rate and the housing market was very stable and so on, ended up in default. All of these loans were turned into financial securities held by many banks, in particular, to get short-term liquidities. Those assets were worth nothing after the underlying mortgages were not being repaid by borrowers. So all of the securities held by all these banks that were used as liquid assets in the short run were now totally worthless. So many banks, many investment banks ended up holding assets that were worth nothing. That led to the financial crisis of 2008. Let's go over the insurance market now. In insurance, a deductible is the amount the agent has to pay the insurance company in the event of a claim. If an accident happens, the agent has to pay the deductible, after which the insurance takes care of the loss according to the contract. What problems can deductible solve? Deductibles can be used to solve both moral hazard and adverse selection problems. A deductible here is the same as a collateral when we talk about banking. In the case of a default, or here in the case of an accident, the consumer has to pay something. The deductible in insurance, the collateral in banking. On one hand, the deductible is a way to screen consumers, to screen customers, because the ones who have this private information about themselves and know that they are at risk, know that the probability of an accident or of a bad event happening is high, they know that they will have to pay a deductible in this case. So they might be more reluctant to accept an insurance contract. The deductible can be used to screen customers ex ante, to make sure only the okay types are going to accept the insurance contract. But it can also be used to limit moral hazard behaviors. Whether it's a bad or risky type of customer or a safe type of customer that gets the insurance contract, once the deductible is included in the contract, it will give them an incentive to behave properly because they're exposed to the risk of having to repay money in case of a bad event. So, a deductible represents less than full insurance. By exposing the agent to risk, you can limit the immoral behaviors. Pretty nice, isn't it? Now, true or false? An insurer asking customers for a medical family history record and a medical examination is a way to prevent moral hazard. So here, the insurance company is trying to obtain some information about a potential customer that it might not have already. How can that prevent moral hazard? Well, it cannot. Remember that moral hazard happens ex post, after signing the contract. Once the contract is signed, if the contract is pretty safe for the agent will engage in moral hazard behaviors whether he provided a lot of information or not to the insurance company. Now it's all about the contract. The insurer asking for information is a way for him to design the insurance contract according to the profile of the customer. So whether such information is provided or not, an insurer cannot avoid moral hazard behaviors if he proposes full insurance. Getting information about a customer is a way to learn more about their type. Are they the risky type? Oh, it's a smoker. Okay. Higher chance of having to go to the hospital. Oh, this person has diabetes. So there are some expenses related to diabetes, such as the monitors and so on and so forth, and regular appointments. Oh, this person has a couple of cancers already and her whole family had cancer in the past. So this person might be predisposed to cancer, which increases the likelihood of this person needing medical care. Same as getting information about a young driver. Oh, this is a young driver. He got his driving license a couple months ago, so he's pretty green. He might get into car accidents. It is more likely for him to get into car accidents than a driver that has been driving for 20 years, never got into any car accident, and so on and so forth. The type of car the driver is driving might also be a source of accident. So, by getting this information, the insurer can reduce the uncertainty related to the probability of having to pay the customer for his loss. If he knows that it's a risky type of customer, he may still offer an insurance contract. But now he knows that it is highly likely that the insurance company will have to repay the customer for health expenses, so the insurance premium will just then be higher. So it is not a problem that risky customers are getting an insurance contract. The problem is about the insurance company not knowing their type. If they know it's a risky type, no problem, they can increase the insurance premium. If they don't know, this is where they are going through a risk. But whether the customer gives this information away or not, if the insurance contract itself does not expose the agent to a risk, then having this information or not will not, by the insurance company, will not prevent the agent from engaging into moral hazard behaviors. In 1914, the Ford Motor Company started paying its workers $5 per day, while the average at the time was around between $2 and $3 a day. How is this fact related to moral hazard? So, I need to give you a bit of context. At that time, turnover, which is the rate at which employees leave a workforce and are replaced, was very high, and workers were often actually drunk at work. It was an era where people were showing up at the factory. The job was not very interesting. They were working on a conveyor belt, assembling pieces and passing them to their coworker. So pretty often they would come to work drunk, or they would not show up, or often leave the job to go for another job. A high turnover rate can be a huge cost to a company because the company needs to constantly update contracts, stop the contract of someone who is quitting, and look for new employees and start the contracts and so on. That also represents a huge administrative burden on the accountants, who constantly have to change the way payroll is organized, who payroll goes to. Plus, workers were not very motivated, probably due to the nature of their work. Ford, pretty smart, raised wages by a lot. That represented around twice as much as any other factory in the area per day. By raising wages that much, workers got incentives to stay at the company and work hard. If they get laid off, they will go from $5 a day to $2 or $3 a day somewhere else. That represents a huge pay cut. So workers got an incentive to come to work, be serious about it, and not quitting. This idea is related to the concept of efficiency wage. It is the minimum wage for which a worker is not going to shirk, is not going to be lazy. By doing so, Ford managed to reduce turnover costs, make his employees work hard, and even provide them income to consume his cars. So another good move from Ford was to think, well, who is going to buy my cars? My employees and other people, consumers, are going to buy my cars. So I need to pay them a sufficient amount so that they can in turn consume my products. If you consider a closed economy where you produce domestically and your product is consumed domestically, wages can represent a cost to the firm, but also it represents a purchasing power. The more the population is paid, the higher the income in the population, the higher the consumption. So the higher the demand, and the higher the profits. So when there is an increase in productivity, that usually translates into a reduction in costs, an increase in profits. Those profits can be used to increase the wages of your workers as well, because if you can produce more for a lower cost, you also need a demand to absorb this extra amount of production. So profits and high wages in a closed economy go hand in hand. If you want to sell, you need to find people to buy. If you consider an open economy, however, if you produce but export most of your production, then you don't need your domestic workers to be paid a high amount because they're not the target. You don't want to sell your product to them. You want to sell the product to other countries. Efficiency wage is this idea that if you pay somebody the minimum amount, the minimum wage, then why would he work hard? He's going to do the strict minimum amount of work he's required to do. If, however, you pay a worker more and you make him aware that he cannot get paid as much in other companies, then he's going to realize that he needs to put a bit of effort if he wants to keep his position. Especially at a wage which is higher than average wage, other people will be in line, so there will be a huge labor supply for that position. So the employer then gains some bargaining power. He says, I'm going to pay you more, but just so you know, you better work hard because there is a huge lineup of applicants who are willing to work hard for the same wage. This is especially the case when there is a minimum wage law. If people know they can make minimum wage anywhere, then if you want to make them work hard, propose them a slightly higher wage than what they could make somewhere else. If you pay them minimum wage, they will do the minimum amount of work. Effort, remember, is costly. Why would they work extra hard if they make the same amount of money no matter what, which is a legal minimum amount? So here, the agent, the worker, is exposed to a sort of risk. The risk is losing his position and losing this very nice wage if he doesn't work hard. Even though the wage is fixed, in principle, for a fixed wage, the agent doesn't provide effort. But knowing that his outside option is way worse than his current position, he will probably provide effort to keep it. So here, promising a higher wage than other places can be a way to solve moral hazard problems. But it is more of an implicit contract, because the contract right now just says, I'm paying you $5 a day. It's fixed. If you don't think about the outside options, then, since the wage is fixed, the worker will provide little effort. So the contract is kind of implicit. Being aware that he cannot get paid as much elsewhere, he's going to work hard to stay in the firm. Final case. How can making workers work in a team solve moral hazard problems despite a fixed wage? A fixed wage should give no incentives to provide effort. But how can making workers work in a team solve that problem? Well, the nature of the work can also limit or prevent moral hazard behaviors. If an employee's output depends on other employees' output, then the worker will have implicit incentives to work hard so as to not prevent his colleagues to get work done. If you work in a consulting company and you work on a project basis, you have deadlines. If you don't meet your deadlines, then it will represent a loss for your firm and your position will be at risk. If meeting deadlines also implies working in a team, then knowing that the rest of your team cannot work as long as you haven't done your part yet is going to give you incentives to get your work done. It is some kind of a peer pressure. Waiting for the others to get their part done is a way to put pressure on them. On a conveyor belt, you could think about that too. Output pretty often is determined by the speed of every worker on the belt. Thus, workers don't have incentives to shirk as it slows down the whole process. If one person on one end of the belt is way too slow, then it prevents you from getting your work done. This will slow down the production process, and this might lead you to having to work extra time to meet your target of the day, or other things like that. Typically in a factory, there is a daily output target, depending on, of course, orders, depending on demand. And very often, if you manage to get the output, if you manage to produce the output before the end of your working hours, you might be able to finish early while getting paid. That's an extra incentive to work hard. So peer pressure is a form of implicit contract that can make somebody work hard even though he's paid a fixed wage. If you work independently on your own, then chances are that a fixed wage will make you not provide any effort. Becoming dependable, where people are relying on your work, might provide you implicit incentives to get the work done, even if it means working overtime. And in fact, this is something that happens a lot in many industries, such as the video game industry with crunch time. When there's a deadline to meet and other people waiting after you work, then you move into crunch time mode where you have to work extra hours without getting paid necessarily. Those contracts can be pretty brutal, and we have seen bad consequences of such contract. For instance, with the video game Cyberpunk 2077, I think that's the name of it, where the game was promised to be released for Christmas 2020 by the marketing wing of the company. Why Christmas? Because Christmas is where most video games are being purchased. In general, parents pay video games to their kids. So usually you have a lot of video games being released around Christmas time. A lot of Disney movies as well. Disney in particular, because they want to sell goodies. So any industry that relies on selling goodies and selling games will release a lot of the products just before Christmas, something around September, October, so that kids can ask for those games for Christmas. The marketing aspect of the company, the marketing wing, the marketing team of the company promised that the game would be released by Christmas without asking the developer's opinion. Developers knew that the game would not be done in time. It would be full of bugs. There would be problems. The marketing team was aware of that. They still released the game, but the game was so incomplete and unfinished that he got very bad critics. In fact, Sony and other, I think other video game platforms, maybe Microsoft as well, but I'm not sure, proposed to reimburse customers for the game for almost no reasons. Since then, patches have been released. Patches just add updates about, it could be the texture, it could be the bugs, it could be a specific part of the story that has been corrected, and so on and so forth. The game is still not perfect on PlayStation and on Xbox 360 or Xbox One. I believe it's still pretty good quality on a computer though. And the studio experienced a drastic decrease in its stock price due to this failure. The studio was very famous, and there was a lot of hype around the video game around Cyberpunk, because this is the same studio that created the Witcher series, which is very famous and had great critics, great reviews. Because of the Cyberpunk scandal or failure, the company stock price has decreased a lot, and now the company is trying to fix its mistakes by trying to provide a decent version of the game sometime this year, I believe. So, to sum up, adverse selection is the consequence of a situation where some parties in a transaction or a contract have hidden information, something about their own type, something about some characteristics that the other side of the market, in general the principal, would like to know. This leads to inefficient outcomes, a non-Pareto efficient outcome, where some contracts are not signed, although they would have been if information was perfect. A way to solve this adverse selection problem is to make information available to the other side of the party as well. This is where signals kick in. A signal can be used as a way to convey information about one's characteristics. Not everybody wants to use a signal. Remember that a low ability worker doesn't want the employer to know that he is a low ability worker. He would like the employer to believe that he is a high ability worker. So a signal can be used to convey an information which is not necessarily the one related to you. But for the signal to work, it has to be credible and costly to fake. How can it be made credible? Well, if I am trying to sell you my product and I'm telling you, I swear it's a good quality product, this is not credible. I will never tell you that what I'm going to sell you is a bad product. I will always try to convince you that it's a good product. So, I am not credible. But there could be a third party that could inspect my product, or maybe I could propose a warranty on the product as a way to show that I am confident in the quality of my good. If you try to sell a car, you could run the car through a mechanic. A mechanic could go through it, make an inspection, make a report, and say the car is in a good condition. That would be a way for a potential buyer to make sure that the car is trying to buy is a good quality car. The signal has to be costly to fake, however. Because if it is not costly to fake, then anybody can use this signal. If education is cheap and pretty much free for all, even low ability people might get an education. And if education is not improving your abilities, if it's only used as a signal, then an employer will look at two different resumes coming from two different people. They will both have a degree from a university. the employer won't be able to use the degree as a signal to tell them apart. So the signal has to be costly to fake. It might be costly for low ability workers to get access to this signal so they cannot pretend that they are high ability worker when they are not. If it is costly to fake, only a smaller portion of the agents are going to acquire the signal, and this will be used by the other side of the contract as a way to tell who is what type. You have a degree, you must be high ability worker. You don't have a degree, you are probably a low ability worker. So I'm going to pay the one without a degree less and the one with a degree more. If it is not too costly for anybody to get the signal, then the signal is useless. So nobody is going to acquire the signal. And everybody will be pooled. Everybody will be in the same pool. Moral hazard is another side of the asymmetric information problem. Moral hazard is the consequence of a situation where one or several agents take hidden action. In this case, actions are unobservable and interests between the different parties in an agreement diverge. In this case, the side of the transaction who can engage into unobservable actions might decide to engage in a behavior that is not the behavior the other side of the transaction wants to happen. Typically, a worker who knows that his efforts are not observable will engage into lazy behaviors. The principal, the employer, might want him to engage into a hardworking behavior. If it is not observable, it might be difficult. A way to solve this problem is to expose the agent to risk. A variable pay, partial insurance, a collateral, any clause in the contract that nullifies the contract based on observable characteristics will give the proper incentives to the agent. But the contract will have to include features based on observable characteristics. If we cannot observe the worker's effort, we can at least observe how many sales he's going to generate. He might not work hard and get good sales, or might work hard and get good sales. If we don't observe the efforts, we can at least base the wage on the output, on the sales, which is why we have commissions, piece rates in general, sharing profits, royalties, bonuses. All of those types of compensation packages are based on something that is observable by the employer. Another way to solve the moral hazard problem is to be able to observe actions. So if effort is unobservable, maybe monitoring the worker or monitoring the driver in a car and so on and so forth could be a way to make actions observable, and now the contract can depend on effort. The pay can be contingent upon effort. Monitoring in general is costly and doesn't happen very often because of the nature of the tasks at hand, simply. Another solution is the transfer of ownership. The principal can keep a fixed amount of money, and all of the extra money generated by the activity, whatever it is, will be going to the agent's pocket. In this case, we say that the agent is made the residual claimant. He's claiming all of the residual profit that is being made, and he's paying a fixed fraction or fixed amount of money to the principal. In the tutorial about adverse selection, I talked about cab drivers. That's exactly the case. Cab drivers, cab companies might take a fixed amount of money from the driver as a rent, and any extra dollar made by the driver is going to go directly to his pocket. This will give him incentives to work hard, to work longer hours, to catch as many customers as he can, rather than if he's getting paid a fixed wage or if he has to meet a daily quota of customers. Once he meets the quota, he's done, he goes home. We also have forms of implicit contracts, as the one I just mentioned, which are ways to make sure that the employee in general or the agent is not going to engage in moral hazard behaviors, is not going to shirk. I talked about the efficiency wage as a way to keep a worker motivated. I am paying you more than other industries, so you better work hard to keep your position. Or I make your efforts and your performance rely on other people's efforts as well. Then, if you want to get things done, if you want to produce the output and meet the deadlines, you need to work hard so that the rest of your co-workers or your partners in your team are able to work as well. Promising a promotion can also be a way to keep a worker motivated. You can hire a worker at a very low wage and say, it's a low wage, yes, maybe lower even than other industries, but you are going to evolve fast. Within 6 months, we expect you to go higher in the ranks and you are going to see your pay increase gradually. So the promise of a promotion can also be a way to keep a worker motivated. If you do good, if you show good performance, even though I don't see your efforts, if you show a good performance, I will reward you one way or another. Since efforts in general are directly correlated with output, with performance, the worker will have an incentive to provide a lot of efforts, to have a good performance, and then to get rewarded. That's it for this tutorial on moral hazard. Have a good rest of your week and see you in the next one. Bye.